So this presentation primarily details out binomial trees and all the associated concepts with binomial trees. It's drawn on from the standard text of John Hull, Options, Futures and Other Derivatives, 9th edition. So some of the questions which appear towards the end of the chapter on binomial trees have also been addressed in this presentation. Typically those questions which come in the FRM or PRM or CFA examinations. So the intent of this presentation or deck is primarily to familiarize you with binomial trees and is no way intended to assist you in any live trading in options or securities using concepts and ideas which are given in this presentation. So let's move on to the next slide, where we start off with binomial trees. So let's start with a simple example of a stock which is currently selling in the market for $20. So based on your own analysis or guesswork, in 3 months you predict that it will either be $22, in which case it goes up from its current price of $20, or it goes down to $18, because stock prices always fluctuate over a period of time. They either go up or down depending on the noise in the market and the news which is floating around on the particular company which has that particular stock in the stock market or exchange, as the case may be. So let's take this example a little further. So let's assume that you have a 3-month call option which is being traded in the market with a strike price of $21. So let's say after 3 months the stock price actually goes up to $22 based on what you had anticipated. If it goes up, so the option gets exercised being in the money because the stock price is more than the strike price and the option value is positive. It's basically $1. If it goes down from $20 to $18 because the market has tanked, in which case the option does not get exercised and the option price is 0. So this is primarily an example with the assumption that the underlying security is a 3-month call option. So when it expires, it either has a value of $1 or 0, depending upon whether the stock prices move upwards to 22 or downwards to 18. So moving on from the previous slide, as I said that the price of $20 can move up either to $22 or it could move down to $18. So let's assume that you are long on shares of that particular company. Let's assume that you're long on delta number of shares and you're short on one call option for that particular company. Now I presume that you are familiar with the terminology of being long or short, in the money, out of money, and so on and so forth. If you are not, just brush up your skills on the terminology through accessing the internet. It's fairly straightforward to do that on Google. So coming back over here, so if the price of the security is $22, so the value of your portfolio will be 22 times delta because you're long on this stock, and the value of your option is -1 because you're short. So whoever you have sold that particular option to is going to exercise the option on maturity after, let's say, 3 months. So the value of your portfolio is 22 delta -1. Assuming that your stock price falls to $18 from $20, then the value of your portfolio will be 18 delta. Now the option value is $0 because the option will not be exercised. So the portfolio is riskless when 22 delta -1 is equal to 18 delta. So from this equation you get that delta is equal to 0.25 when you solve for delta. And I'm going to explain to you a little more as to why this would be riskless in the subsequent slides. So let's take this example a little further. So the risk-free rate we assume is 12%, and in the previous slide we saw that you're long on 0.25 shares of the underlying security and you're short on one call option. So the value of your portfolio in 3 months would be 22, which is the current price, into 0.25 because you're long on 0.25 share, -1, which is the value of the call option because the option is going to be exercised at a strike of 21. So 22 minus 21 is $1. So that gives you $4.50. That is 4.5. Now if you discount this 4.5 back to today, which is 4.5 into exponential raised to the power of 0.12, 0.12 being the riskless free rate, times 0.25, because 0.25 is the time period, delta t, which is basically 3 months divided by 12 months to convert it into years, which gives you a present value of 4.3670. So you're long on 0.25 shares of the underlying and short on one call option. So today the value of your portfolio should be $20, which is the price of the security today, into 0.25 minus F. So F is nothing but it's the value of the call option. So 20 times 0.25 is 5 minus F should be equal to 4.367, and this 4.367 comes from the previous slide where you calculated the present value of the option. So solving for F, this gives you a value of $0.633. So the value of the option today would be $0.633. So the earlier trees which we saw so far can be generalized in this diagram. So S0 is basically the spot price, S0U is the upward movement, so S0 becomes S0U if there is a movement of the price upward, and therefore U is obviously greater than 1, and the equivalent value of the option is FU. Likewise, if it goes down, the value of the portfolio is S0T and the value of the option would be FD. And if you discount it backwards, like what we saw earlier, you basically get small f, which is the value of the option today, assuming that you know the period of expiry for the option and the risk-free rate. So we can generalize what we saw earlier in the example so far, where you were long on delta shares and short on one derivative. So the value of your portfolio t months from now could either be S0 u times delta minus fu. So S0 is the spot price today of the security. U is the upward movement, which is always greater than 1, and delta is the number of shares on which you are long. And if you are short on the derivative, the value of the derivative, if it moves up, can be fu. Likewise, if the value of the underlying share moves down by a factor of d, the value of your portfolio would be S0 times d times delta minus fd, which is the value of your option at time t if the spot price goes down by a factor of d. So the portfolio is riskless when both of these equations are equalized. So S0 u times delta minus fu should be equal to S0 d times delta minus fd. So solving for delta, this gives you delta is equal to fu minus fd divided by S0 times u minus S0 times d. So the value of the delta is basically nothing but a change in the value of the option to a change in the value of the underlying security. Now this slide is a bit mathematical in nature with a couple of equations, but no need to get alarmed. It's important to understand the background of how these values are derived so that the associated formulae get embedded in your memory. So the first thing is that the value of the portfolio at time capital T, which is maturity, is S0 u times delta minus fu. So assuming that the price of the share goes up by a factor of u and you have delta shares, so at time t the value would be S0 u times delta, and fu is the value of the option at times t, or at the expiry date. So therefore the value of the portfolio today would be S0 u times delta minus fu, because you're short on the option, discounted at e raised to the power rt, where r is the risk-free rate, like what we have seen in the earlier slides. So therefore it would be, today's value would be S0 times delta minus f, where f is the value of the option. So this is another way of expressing it. So you get f is equal to S0 times delta minus S0 times u times delta minus fu, discounted at e raised to the power of rt. Now from the previous slide, we know that delta is nothing but fu minus fd by S0 times u minus S0 times d, which is change in the value of the option to the change in the value of the underlying security. So substituting these values, you get a very important equation which you need to remember, which is f, the value of the option, is exponential e raised to the power of minus rt times pfu plus 1 minus p times fd, where p is the probability of the stock price going up. So Obviously, if the P is the value of the probability of the stock price going up, the probability of the stock price going down is 1 minus P. So therefore, FU is multiplied by P, and FD, which would be the value of the option if the stock price goes down by a factor of D, would be 1 minus P times FD. So this is an important equation to keep in mind. So just to recap, there are two important formulae here. F, which is the value of the option, will be equal to P times FU plus 1 minus P times FD, and discounted at e raised to the power of minus RT. Now P over here in this formula is equal to e raised to the power of RT minus D divided by U minus D. So this is an important derivation, so I'm not getting into the process of how this has been arrived at, but it's important to remember this because it is widely used in many of the questions which form part of the end of chapter in this textbook of John Hull. So just to recap, P and 1 minus P are the probabilities of an upward movement or a downward movement in the price of the underlying security. So what the value of a derivative would be is that it's the expected payoff in a risk neutral world discounted at the risk-free interest rate. So S0 moves to S0 times U, or it comes down to S0 times D with corresponding probabilities of P and 1 minus P, and the resultant values would be FU or FD depending upon whether the price has moved up or whether it's gone down. So in the numerical example we've been looking at so far, U is equal to 1.1 and D is equal to 0.9. And why is that so? Because 20 times 1.1 is 22 and 20 times 0.9 is 18. So 22 is the resultant price if it moves up, and 18 is the resultant price if it moves down. And 12% is assumed to be the risk-free rate with a 3-month expiry date for the option, which is basically in years 0.25, and FU is equal to 1 because if the price goes up to 22, the option expires in the money, and the strike price, if you remember, is 21. So 22 minus 21 is 1, and obviously if the price drops to 0, the option would not be exercised, and FD therefore is equal to 0. Now from the previous slide, remember that probability formula is e raised to the power of RT minus D divided by U minus D. So you know all the values of R, T, D, U. So plugging those numbers into this, you get P equal to 2.71 raised to the power of 0.12, which is the risk-free rate, times 0.25, which is the value of T. E is basically 2.71. The value of E is 2.71 divided by 1.1 minus 0.9. So this comes to 0.6523. So the probability is value is 0.6523. So P is equal to 0.6523, and 1 minus P will basically be 1 minus 0.6523. So if you remember from the previous slide, the formula for F is e raised to the power of minus RT times PFU plus 1 minus P times FD. So you can plug in those numbers here in this formula, and you get the value of F to be $0.633, which is similar to which is the same value what we got in one of the earlier slides also. So now we have reached a point where we can talk a bit about risk neutral valuation. Now there are certain assumptions which are made with respect to risk neutral valuation. The first of these is that investors do not increase the expected return they require to compensate for additional risk. And this is where we call this as a world where investors are risk neutral. But however, we know today that more risk means more reward. So investors would expect a higher rate of return if the level of risk which they are assuming increases. A risk neutral world has basically two features, which is directed towards simplifying the way derivatives are priced. So the first assumption here is that the expected return on a stock is the risk-free rate, and the discount rate which is used for calculating the expected payoff of an option is the risk-free rate. So we are familiar with this expression P times FU plus 1 minus P times FD, which is the expected future payoff of an option in a risk-neutral world, and states that the value of the option today is the expected future payoff in a risk-neutral world. Most important point, discounted at the risk-free rate. So the expected return of a particular option E of ST is equal to P times S0 times U plus 1 minus P times S0 times D. So this can be further simplified as P times S0 within brackets U minus D plus S0 times D. Now from the earlier slides we know that P is equal to e raised to the power of RT minus D divided by U minus D, and substituting this value of P in this equation we get E of ST is equal to S0 times e raised to the power of RT. Now what does this mean? This means that as the stock price grows on average at the risk-free rate when P is of an upward movement. So first step is we calculate what the probabilities of different outcomes would be if the world were risk neutral. Now having calculated the probability from that formula P equal to e raised to the power of RT minus D divided by U minus D, remember R is the risk-free rate, you can then calculate the expected payoff from the derivative and discount that expected payoff at the risk-free rate of interest. Now how does this risk neutral valuation translate into a real life example? So let's go back to the example we were discussing so far. So S0 is 20, which is the price of the security today, and which we said can go up to 22 or go down to 18 with the probability of P and 1 minus P for an upward or downward movement respectively. So 20 times e raised to the power of 0.12, which is the risk-free rate, times 0.25, assuming it's a 3-month option, should be equal to 22 times P plus 18 times 1 minus P. So if you solve for P, you get P equal to 0.6523. You can also calculate the value of P from the formula P equal to e raised to the power of RT minus D divided by U minus D. So you get the same value, which is 0.6523. So this is how you calculate the probability using the formula and the binomial tree which you are referring to for calculating the probability of movement of the share price. Now you have calculated the value of P. Now, given the value of P, how do you value the option using risk neutral valuation? So, as from the early example, 20 can move to 22 or down to 18. If it moves to 22 with a strike price of 21, FU, which is the value of the option, will be 1, or it can be 0 because the stock price is less than the strike price, and FD will be equal to 0 because the option does not get exercised. Now we know that the value of the option is F. It should be equal to e raised to the power of minus RT times P times FU plus 1 minus P times FD, so which is equal to e raised to the power of minus 0.12 times 0.25 into 0.6523 into 1 plus 0.3477 into 0, which gives you a value of $0.633.